Hello, everybody. This is Alan Elman, the Blue Collar Investor, and I'm creating this video for you to show you a trade that I executed this week, a real-life example with Wheaton Precious Metals Corp., which is listed on the New York Stock Exchange under the ticker symbol WPM. Now, this is a four-day trade because Monday, 9/1, was Labor Day. So I initiated this trade Tuesday morning, September 2nd, about 11 a.m. in the morning, and it expires today, which is 9/5, Friday, September 5th. Right now, it's about 12:30 p.m. Eastern Time, so there's about 3.5 hours to go until these contracts expire. Now, these are both defensive trades, two contracts you're going to see. I've been telling you, those of you who've been following me over the last 18 years, about how many contracts I sell all the time. Last many years, I've been doing between 100 and 150 contracts per month. Right now, I'm showing you two of them. They're both defensive in nature because I've been defensive in nature for a good part of 2025 over my concerns as to the impact of tariffs and the jobs and so on and so forth. Now, this particular week, the market is really going nuts because, on the one hand, it's really happy and looking forward to what they believe will be an interest rate cut at the September Fed meeting. I kind of think there will be one also. So the market is feeling pretty good about that. But this morning we had a weaker than expected jobs report. So then the market is starting to worry about that. So right now the market can't figure out what to do. As I'm creating this video, it's down today, Friday, September 5th, about 0.5%. Okay. So again, you're going to see two contracts that I sold of WPM, put sale, out of the money, defensive in nature. All right, here we go. Now, why did I select Wheaton? Well, I'm showing you now a little piece of our premium member stock report and watch list, which we do for our premium members over the weekend. And I highlighted for you in the yellow roll the part that has this particular security, WPM. Now, let's start that it's in bold here. Why is that? That tells you right off the bat that all the technical parameters were bullish. It's not a mixed price chart. I'm going to actually show you that in a couple of slides here. So that's bullish, of course. Now, you see here, where did we get it from? Well, it was in the IBD 50. It's number 48 on the IBD 50. Folks, it's really hard to get onto that list because you have to be an elite performer from both technical and fundamental perspectives. So, yep, that was in there. Very good. Now, it's in the mining industry, which is currently ranked A, and it was ranked A last week because the Wheaton was also on our list last week. Looking over now at the mean analyst rating, the consensus of the analysts is 1.61, which is outstanding because it runs from 1 the best to 5 the worst. So that's very good. The on-balance volume has an up arrow, meaning more cash flowing in on up days than on down days, another bullish signal. And now if we move over to the implied volatility, 32.0, that's robust and it's really perfect for option selling because we get a nice premium return and we could still craft our trades either way, defensively or more traditionally, which is more aggressively. All right, so that's good. It had adequate option liquidity. That's what that Y is there for. And there's no issues with the earnings and ex-dividend date. So all in all, really good so far. Now, looking at a 1-month price chart, you could see that it was actually underperforming the S&P 500 until there was a crossover towards the end of August and it started to head off to the moon. Now, this is a short-term chart. You're going to see a longer-term chart, which is going to look much more bullish. But you could see here when I executed the trades that, Wheaton was taken off to the moon and in comparison to the S&P, which was kind of heading down at that point in time. That was on Tuesday. Now, here's a 1-year price chart with the 4 technical parameters we use. Let me run through them briefly with you. Number 1 are the exponential moving averages. The blue line on the top is the 20-day EMA. shorter term, which is higher than the longer term red line 100-day EMA. That's bullish. You could see the price bars are at or above the 20-day EMA. That too is bullish. Overall, you don't have to be a genius to see this is an uptrending chart. For months, it's been an uptrending chart. So that's number one. Number two is the MACD histogram, which are these blue bars. And you can see it recently at the end of the green arrow turned up above the zero line, a bullish signal. Number three, where this blue arrow is the stochastic oscillator, which is this black line. Again, you don't have to be Albert Einstein to see that it is ascending and bullish in nature. Now, are these signals meaningful? We look to volume, number four. And you can see here the volume bars are holding up well. Had they been declining or weakening or just disappearing, well, then these bullish signals 1, 2, and 3 would be less meaningful. But no, volume's holding up. This is a bullish chart, ladies and gentlemen. Now, I took a look on Tuesday morning, about 11 o'clock. That's usually when I start my trading. Wheaton was trading at 101.70. So you look for an out-of-the-money put strike. And I went to the 99, which means that Wheaton would have to drop $2.70 to breach that out-of-the-money strike in 4 days. Is it possible? Of course. Is it likely? Probably not. But in any case, there's always some risk with our trades. No such thing as a no-risk trade that's going to beat risk-free returns. No such thing. Not legally anyway. All right. So I looked at the 95.99 strike. It had a bid price of 43.5 cents a share. All right. So what I'm looking to do is I'm looking to get significant returns, which, as you'll see in a minute, I did. Again, not a grand slam home run, but I do singles and doubles all day long. And you get protection to the downside. That's what I'm looking for. Capital preservation and generating cash flow. Feed that into our trade management calculator. On the top section, you could see I entered the price 101.70, out of the money put strike 99.44 cents, 200 or two contracts representing 200 shares. The spreadsheet tells us, yep, it's a 4-day trade. Now look at the break-even price point from 101.70 to 98.57. So to get to the break-even, it would have to drop down by more than $3 a share. Now the brown cells are the important part of these calculations. And based on a 4-day trade, the time value return is 0.44%, almost 0.5%, annualizing out to over 40%. Significant? Yes. I know you'll agree with me on that. Yes, it is significant. Now, what if WPM drops from 101.70 to below 99 and we take no action to buy back the put? Well, then we will have purchased it at the break-even price point of 98.57, which represents a 3.08% discount from when the trade was first executed. And remember, we're talking 4 days here. So here we have just a summary of what I just told you, about 0.5%, 40% annualized, and about 3.08% to break even. Now, how much did I collect? I collected 43.5 times 2, $287 was collected. Now, compared to winning the lottery, that's nothing. But again, these are 2 contracts out of between 100 and 150 that I do every month. Singles and doubles, ladies and gentlemen. Never grand slam home runs with these strategies, okay? But I'm just a singles and doubles kind of guy because I don't look to incur a lot of risk. That's just not me. There's nothing wrong with incurring risk if that aligns with your personal risk tolerance. But for those of you with capital preservation in mind, not willing to take a lot of chances, then these strategies may be appropriate for you. Now, our spreadsheet will also give us our total portfolio initial returns. Now, I just put entered so you could see it, these 2 contracts. So it came out to, as we said, $87 cash received. The amount of capital that we have to use to secure the 2 put trades is 19,713. Here's your 0.44%, and that would annualize out to 40%. All right. Now, here we are, ladies and gentlemen. It's Friday, September 5th. It's about 12:30. And I just checked, and Wheaton had gone up to 105.81. All right. There's only about 3.5 hours left until expiration. So it's right now, it's $4.11 higher than when I entered these trades. It was 101.70, if you recall. It's $7.24 above the break-even price point, 98.57. And it's $6.81 above the put strike. Remember, would have to drop below 99 to be subject to exercise. And you may not want to buy the shares. Anyway, with 3.5 hours to go, I'm not quite lighting the victory cigar yet, but it's right here next to me and I'm about to do it. So it's looking very good. So let's just summarize now. You can generate significant returns. Yes, even for a 4-day defensive cash secured put trade. It is possible. And this isn't the only security which you could do it with. You could craft your trades. There's no one size fits all. I hate that. Okay, you have to craft it to what you feel is going on in the market today. I've already told you I'm a little concerned, a little more defensive than I had been the last couple of years. But you know, you may feel differently, and that's okay. And you may be either more aggressive than I am or less aggressive than I am. So you can craft your trades to what is right for you and your family. Now, in the case of Wheaton, yep, we got a nice 4-day return. Currently in a very favorable position for success. We'll see over the next couple of hours, but would have to drop an awful lot to turn this successful trade into a losing one. And remember, as I always tell you, these are not no-risk trades, but they are in fact low-risk trades. And if we do all the things that we could do to throw the odds in our favor, they are very low-risk trades. So that ends another video of sample trade that I use. I'll continue doing these for you because the feedback has been very favorable and it's kind of easy for me anyway because I make these trades. And so I'm happy to share them with you. So I hope you enjoyed this video. Always hope you benefit from it in some way. Maybe I'll throw you some kind of nugget that you'll be able to use for your particular trading style. So that's my hope anyway. So thank you for listening, and we'll keep doing these. Next week I'll have another one for you. As always, this is Alan Ellman, the Blue Collar Investor. Take care, everybody.